Hello and welcome to another episode of Darwin Investors. Man, we got a big week planned this week. So we've got the FOMC meeting on the 26th and 27th. We got the GDP results that are going to come out on the 28th. We've got all of the tech earnings coming out this week. We had a big week last week right up until Friday. Both can be explained, one through earnings and one through covering your short positions if you're a large bank. So we got a lot to unpack this week. Let's go ahead and get into this. So the market had a really nice week this week, and all of the indices were up, and a lot of that had to do with earnings that just started coming out this week. And as it turns out, the warnings of an earnings apocalypse may turn out to be greatly exaggerated. And actually, the earnings were given credit to this rise as solid earning reports boosted the shares of many companies, even as a stronger dollar weighed on the results of others. And the stronger dollar thing is kind of funny. It's sort of like, to me, like the dollar is stronger than a lot of places in the world because a lot of places in the world haven't yet raised interest rates. However, all we are is the prettiest pig at the fair. I mean, it's not like everybody feels like our economy is just going amazing and that's why the dollar is so great relative to the world. It's just like our dollar seems to be strong relative to others because they haven't yet hiked up interest rates. Now, the European Central Bank actually hiked up the interest rates for the first time in 11 years earlier this week. So we should see that leveling out. And Japan, I believe, hiked up interest rates as well. So that sort of thing should help out as well. When you look at Yardini here, they say that the S&P 500 revenues and earnings growth rates, they've got this chart here that shows that our earnings that are coming out as a yearly percent change are actually among the best of all time right now, right this second. Now things are coming down. You can see that they go negative during times of recession, like here in 2020 and 08 and right around the dot-com bubble. You can see that the earnings per share are decelerating rapidly. However, they have not turned negative. But even at this low rate, historically, it seems to be all right to be in the like 8 or 9% range. That seems to be okay, so long as we don't go negative. And by negative, I mean wildly negative, because we went a little negative here in 15, and then it came storming back. As a matter of fact, if we're going to have a recession and that sort of thing is going to happen right now, I would say that what we're going through now, because of our low unemployment rate and high inflation, is that we might end up in something closer to, say, like a 2015, 2016, or perhaps a 97, 98, but nothing like this and nothing like that and nothing like that. That's my feelings going into this. It's just kind of like I'm reading the tea leaves as a recession and as of our economic data seems to be coming in. This is kind of the way I read it, that if we're going to go negative, it's going to be more like this. It's not going to be like, say, this. Another positive thing that's happening is that our supply chain seems to be loosening up a little bit. This article was published on July 22nd, which was yesterday. West Coast ports reduce idling vessels as container supplies increase. The queue of vessels waiting to unload goods at the Port of Los Angeles has fallen 80% since the start of the year. Now, ideally, we would like to see this get to zero. We don't want to see any waiting vessels. However, this has gone a lot better. The backlog of vessels waiting outside Los Angeles has fallen from a record high of 109 all the way down to 20. And again, we would like to see that get down to zero, but 20 is a really big improvement. Plus, the port is moving tons and tons of cargo. They moved 876,000 20-foot equivalent units in June. That's the best record in over 100 years. So all of these earnings reports are rolling in, and what it's showing is that there's been no crash in spending. The banks are reporting that people have really good balances in their bank accounts. The credit card companies are showing that people are spending on travel and entertainment, also on goods. Amazon Prime Day came in, showed that the retail sales were actually up really good. We're showing that there's been that business travel is coming back. Oil seems to be range bound. Bond yields seem to be range bound. We're seeing a bunch of positive economic data, and for that reason, the markets have been on an incline. Now, despite all this data, there does seem to be a disconnect between sentiment and reality. The sentiment is that we're going into a recession, that everything looks really bad. And the reality is, as earnings come in and as guidance goes forward, that things aren't as bad as it feels or as the sentiment makes it seem like it is. And I can't blame anyone for feeling like things are really bad. Groceries are really high. The gas pump is really high. I mean, all we have in this world is our own perceptions, the things we see every single day. And so because the things we see make us feel that everything is going really, really badly, it's kind of hard to then take a step back and say maybe things aren't as bad as it feels. And I guess we're going to find out this Thursday whether or not things are as bad as it feels, because the GDP is going to come out and they're going to tell us the real numbers. Now, the bears are going to be out there. They're going to say, hey, yeah, I never said we were going into a recession right now, even though they are. I never said we're going into a recession right now. I said we were going to go to a recession in the third quarter of 2023. Right now is to be expected. We're still cooling off. These are the sort of things that I expect to hear after this Thursday that will still keep this market down. That's all right. We'll get a lot of cheap stock out of it. And I know a lot of people like to look at this yield curve and think, hey, we're going to have a recession for sure. The 210 yield curve has inverted. I guess we're doomed, right? These theories came out a long time ago when bond yields were much higher. Like right now, as we said, the bond yields seem to be somewhat range bound, and borrowing money less than 3% is not as bad as borrowing money for businesses, at like 12% or 15%. Economic growth can still happen under 3% borrowing. It's actually probably still historically low, even as we sit here right now in panic. Now let's have a quick look at the history of bond yield inversion and when this theory was invented and what the yields of the 10-year was at the time of the theory. So the inverted yield curve was first coined as a recession indicator by financial economist Campbell Harvey of Duke University in 1986. We can see here from the 10-year Treasury rate historical chart that in 1986, the bond yields were roughly, say, I don't know, about, let's say, call it 7 or 8%. Now, we would think that Campbell Harvey would be looking at past data to give his current thesis, right? He probably isn't looking at current days, probably looking at the past and developing in this thesis on things that happen. And when he was developing his thesis, these rates climbed as high as, say, about 15%, 14.73%. And so he's looking back at this thinking, we got a 210 bond yield curve inversion. So I guess that means we have a recession on the way, because borrowing money at 15%, it's a whole lot worse than borrowing it here at 3%, right? And Campbell Harvey might have said 3% was pretty good for businesses to still borrow money and grow as an enterprise. So we never really know how these things would play out in the future. That was just a great theory at the time. And right now, bond yields do seem pretty range bound. We're looking at the 10-year right now at 2.75, the 30-year at 2.97. The 2-year, of course, as we said, it's inverted. It's at 2.97 as well, same as the 30-year. I don't know what's going on here. I know that there's quantitative tightening going on and the Fed is releasing a bunch of bonds into the market, and probably they're releasing a whole lot of these 2-year bonds. And that's why the world's getting flooded with these things. Because I mean, just using your own common sense, would you rather buy a 2-year bond at 3% or one that doesn't pay you for 10 years at a lower percentage at 2.75%? I mean, using your common sense, you would see, why would anybody ever buy the 10-year note at this rate than the 2-year at this one, unless the world was simply being flooded with these 2-year bonds. And the only one that was ever buying these bonds to begin with was the Fed and maybe Goldman Sachs. And so the world is being flooded with these things, which means that this rate is being pumped up. But I almost think it's like sort of like an artificial inversion as a result of quantitative tightening. And so what does this 30-year rate have to do, like what's the impact of that on our home mortgages? So how do Treasury notes affect mortgage rates? Now this chart shows the 10-year versus mortgage rates rather than the 30-year. I would have preferred seeing a 30-year Treasury yield to reflect upon what a 30-year fixed mortgage rate is like. But it does appear if the 10-year is around 3%, the 30-year is around 5% to 5.5%. And over here, it looks like if the 10 years at 3.5%, The 5 years at 4.86%. So we're talking about anywhere between, say, 1.3 and 2.5%, depending on whether or not we are in a recession. If we're in a recession, it looks like this spread is a lot higher. Here in April of 2008, it was 3.77, and up here in April of 2008, it was 6.03. And this would be our fixed mortgage rate for a 30-year loan on a house versus the 10-year bond rate. And right now, it's quite wide. We're looking at about 2.5%. We're looking at about 2.98% on the 10-year treasury yield versus 5.54% on the 30-year fixed mortgage. So what impact does this have on the stock market? Well, this past week, I got the living crap squeezed out of me on lows because home builders must be doing really well, because this bond yield seems to be range bound or coming down. Even as the Fed hikes interest rates, people around the world and domestically seem to be buying up these bonds like crazy for this 3% return over the course of 2 years or 10 years relative to, say, buying equities right now. And so this yield can't seem to climb above 3%, meaning that the home mortgage rate seems to have peaked right around 5.5%. Now, we do see that 5.5%, though it seems really high now to what we've been accustomed to, say, for the past, I don't know, like 12 years or so. We can see that 5.5% on a historical basis is not that bad. So home prices aren't spiraling out of control in a way that we might think that they are. So also helping to bring down interest rate hike fears are the fact that Apple put out this story here that says they expect to slow hiring over the next year. Now, slowing hiring is actually really good for the Fed. It's not good for us as human beings, but for the Fed, they're looking at this going that hiring is slowing. We are doing our job, right? So we're trying to bring the number of jobs available to the number of job seekers down to 1-to-1. It doesn't say that they're cutting hiring. Microsoft and Google are doing the same things. They're saying that we're going to slow hiring. Again, very different from saying that we're slashing jobs. So this is all really positive because it shows that earnings and revenue can still increase. Number of job openings per job seeker will actually decrease without causing a huge spike in the unemployment rate, though unemployment claims do seem to be on the rise a little bit. It doesn't seem that it's something that's really high on a historical level. Now, yesterday for me was an amazing day. And I know the market had a bad day, but for the sake of this channel and explaining how this market really works, it was a fantastic day to explain that, and at least as how I understand it. So anybody that watches this channel knows I make a lot of my money in this channel. Actually, all of my money this year has been through options. None of it has been through investing. And so the same could be said for big money players as like Goldman Sachs and JP Morgan. You know, when you get into the stock market, you're making an agreement. You understand volatility. When I buy, say, Google, I understand that as an investment that it can go up and it can go down. And though it went down yesterday on Snapchat, which was kind of funny, I'll get to that in a second, but although it went down yesterday because of Snapchat news, it's not anything that I worry that much about. I figure I can just sell some puts here in the future, maybe buy more shares at a lower price. Say if I'm Goldman Sachs, I could do that. I'm all out of money. But if I was them, I could buy more at a lower price. But in the meantime, I'm going to sell puts, and I know eventually I'll get this money back. However, the money that I lose through options that expired yesterday is money that is gone forever. And so that's how I think of the market. That's how the big banks think of this market. Now I'm going to release a whole separate video that shows what I did when all of my covered calls started getting blown right through the top. What were my options at the time? And it's not all just roll it up and out. There are lots of ways that you can play this and get your money back. But I'm going to show that in a whole different video. And once I make that video, I'll leave a link in the description. I haven't made it yet, but it's just all the moves that I made last week. It's kind of fun to see. It's easy to see what do you do when you win, but it's unusual to see what do you do if you're on the losing end. How do you recover for this? How do you get your money back? So these things are, I think, is a pretty interesting topic and totally separate from this video. So I'll include a link in the description once I make that video about all the moves I made, and I'll show you my own portfolio, how I did it, and what moves that I made to try and get out of it. So what was yesterday and why did I think it was so amazing? And the reason why I think it's so amazing is because yesterday is what I think of as the perfect example of how I look at this stock market. And so the way I explain it is that when you enter the stock market, you're entering a contract with the market that you agree to volatility, right? You know that when you buy Google, things will go up and occasionally go down. And when it goes down, that's unrealized losses. And when it goes up, that's unrealized gains. And so you accept the fact that when it goes down because of, say, bad Snapchat earnings, that's just part of the game. But where you actually make your money is on the options contracts that you trade on these underlying equities. And when you lose money on these underlying equities, that's not unrealized losses. Those aren't fake losses. Those are real losses. And so when Google goes down, what do I think of it as? As a long-term investor in Google, I think that A, I can buy more shares of Google, or B, I can sell puts on Google because I know now it's really cheap and it's not going to go any lower. Why not just sell a bunch of puts ahead of earnings and then make a lot of money, especially as volatility is really high? And then if I'm Goldman Sachs and I have tons of money, why don't I buy a bunch of shares of Google, sell a bunch of puts on Google, because I know that we're about to drive the price of this stock sky high after what we already know is going to be pretty good earnings. But we can drive it down now in the meantime as a result of bad Snapchat earnings release. And that's the way that this market kind of works. Now, we had a lot of good news that also came out yesterday. So when we look at American Express, Amex shrugs off macro fears with huge earnings beat powered by strong spending. As we look at American Express, we can see that their CEO doubts that recession fears are on the way. They had net sales of $13.4 billion when there was only $12.51 billion expected. Their diluted earnings per share were 2.57 versus 2.39. And perhaps the most importantly, their guide was super strong. They released their guide. They said they're going to have a full year sales forecast of 23 to 25% growth, when analysts were only expecting 18 to 20% growth. However, it wasn't all just unicorns and rainbows. They also said that they were provisioning for credit losses of $410 million during the quarter, which is a move that we also saw banks make last month. And now they're doing this because as people have jobs, they pay their American Express bills. They pay off their bank loans. But as people start losing jobs, as the Fed is trying to actively make happen, people start defaulting on their credit card loans. People start defaulting on their bank loans. So the reason why these banks and these credit card companies are forecasting this sort of downturn is because they anticipate an increase in the unemployment rate. Now let's go ahead and compare and contrast American Express earnings to a company that essentially released earnings on the same day. They released it the day prior after market closed, but both market opens had both earnings at the same time. And that would be Snapchat. So Snapchat put out earnings, and the headline is Snap stock tumbles as digital advertising concerns spread. And so Snapchat would be the one we're going to probably look at. So we're either going to go up as a result of American Express, or we're going to go down as a result of Snapchat. RBC Capital Markets analysts cut their price to $10 a share. Snap's guidance for its current quarter confirmed our fears that ad spending is worsening. Everything's looking bad. So who is the Snapchat customer? Who is the people that they're trying to sell the advertising to? Snapchat by the numbers, stats, demographics, and fun facts. So if you look at who their users are, around 54.4% of users are female, 44.6 are male. India has the most Snapchat users at 115 million versus the US at 106 million. France is third with 24 million. So they're females in India and America. And when we look at Snapchat users by age group, let me go ahead and blow this up here. The percent of US adults in each age group who say they ever use these platforms. Snapchat, 65% are between 18 and 29. Instagram, 71% are between 18 and 29. So this is a very young demographic here. Whereas only 13% of Instagram users and 2% of Snapchat users are over 65, and a much smaller percentage are between 50 and 64. Now let's compare this to YouTube. YouTube, 95% of US adults say they use YouTube between 18 to 29. Roughly, say 90% of 30 to 49s use YouTube, and people 50 to 64, let's call it 82%, use YouTube. So a lot more advertisers are going to flock to this channel here on Google of YouTube than they would say Snapchat, where they're ideally targeting 18 to 29-year-old females in India and America. So that's a pretty small subsection of advertisers are going to want to really go to Snapchat. Yet they're going to create some sort of false equivalency between, say, Snapchat and Google. Google has phones. Google has Google Cloud. Google has, you probably Googled to get this particular stock channel. Like everything that we probably use Google 20 times a day just at work, just trying to find things that we're trying to find. There is a huge difference between these two. However, the market makers need you to think they're the same because they need the NASDAQ to come down. And they need it to come down because it went up all week long, and they're about to realize a whole lot of losses in their short positions. And I know this to be fact because I was in the same exact boat. And again, I'm going to make another video that shows how I lost in my short positions and what I did to get out of these short positions. And I'll leave that in the link below as soon as I make the video. So yeah, Snapchat releases earnings at the same time basically as American Express. And which one are we going to focus on? Is it the one that's the financial giant that basically takes the pulse of the world economy as it results to travel and entertainment and spending on goods and retail and things of that nature? Are we going to focus on Snapchat? But it all depends on what we need at the time to make sure that we're not realizing losses. That's the funny thing about this market. So it's like the loss in Snapchat brings down Google. That's like a loss in Peloton bringing down Amazon. Now we know that is goofy. We understand that. But sometimes it's what the big market makers need to make sure that they're not realizing real losses. And I hope this makes sense, but I'll make another video to help make sense of all of this. So what do we have on tap this week? Let's go ahead and look at this week's earnings coming up. All right, so what do we have on tap this week? We have Squarespace, we have F5, which I don't know what that is. Of course, Whirlpool, it's going to be associated with housing. I'd probably stay away from that one. And then we have NXP Semiconductors. They're a big player in the automotive semiconductor industry. I would assume that they're going to have a really nice quarter. Think about every other semiconductor company that's coming out recently. I mean, we're talking about Samsung, we're talking about Taiwan Semi, Qualcomm released some stuff before them. it's just going to be this. These guys are going to have some really nice results. So this might be one that I'm going to sell a put on. McDonald's, I'm not excited about. Coca-Cola, I'm not excited about. They're overpriced. UPS, I'm not excited about. Do I think they're going to beat revenue and earnings? I think similar to, say, JB Hunt and to say CSX and Union Pacific, people aren't going to be excited about the price they've been paying for diesel this past quarter. So I think that what they're not going to go down, but they're going to remain relatively flat from where they are right here today. So I'm not excited about UPS. Alphabet and Microsoft, like we said earlier, we don't really know what they're going to do. I think their revenue and earnings are going to be good, but I do suspect that they're going to sandbag because everybody's expecting terrible earnings, right? So why not, if you're a huge company, take this opportunity to sandbag your forward earnings when everybody's expecting you to do it. So it's a way that you can do it without crashing your stock. I think it's genius. And so I would expect that these guys would probably do this. As a result, I'm going to sell puts on Alphabet as they've already come down on the Snapchat results. And I'm going to sell covered calls on Microsoft because I think that they're purposely going to sandbag knowing that it's not going to destroy their stock, but also it's going to help them in the future. I think Boeing is going to be a car crash as usual. Ford will be okay, I think. I think that okay to bad. Kraft Heinz, consumer staple. Let's see. Meta is actually probably one that's going to be like kind of similar to Snapchat, I hate to say, but they have a different demographic. Nobody really knows what Meta is. I mean, at least I don't know what it is. There are certain companies I don't invest in because I just don't know what they do. One would be Meta, another would be Salesforce. I've even used Salesforce. I'm like, what the hell is it? I mean, I don't know what it is. And so this is one that I don't know, don't care. Okay, so Qualcomm. Qualcomm is another semiconductor company. This is going to be awesome. And I think this timing may not be a coincidence, but Qualcomm comes out just before Apple. Qualcomm goes as Apple goes. So if Qualcomm's quarter stinks, expect Apple's to stink because Qualcomm is they do put a lot of chips into Apple phones. However, they are the intellectual property is theirs of, say, 4G and 5G. Anything with the word G on it is theirs. So as soon as everybody goes away from that technology and into something else, Qualcomm is sunk. But for now, that's all we've got. And so if Qualcomm says that their phone technology and their phone services is doing fine, Apple's going to be fine. If Qualcomm says this is hurting, look out below Apple. So this is one I'm going to be paying attention to, and it's one that I'm going to sell a put on because I think it's going to go up. Okay, Amazon. Amazon was one I was so high on a couple weeks ago, but it went from like $110 up to like $124. Now it's gone from one. Let me go ahead and pull up a chart for Amazon. So we can see here that Amazon's trading at a pretty good high. When I released that last video that how much I loved Amazon, it was trading at about 108, 109, 110 bucks. So I was expecting to go up to like 120 and we can all make like $1,000 per 100 shares, maybe more. But now we're there already. It seems like someone let that cat out of the bag. And so when we look at Amazon over the last, say, 6 months, and you know I don't like technical indicators. I really hate them, actually. But here we're now at a level of resistance relative to a level of support. Before we were kind of like down here, and now we're up here. So what I'm going to actually do for Amazon is I'm actually going to sell covered calls against this underlying. Plus, I don't exactly know what their Rivian holding is going to look like when they release their earnings results, but I have a feeling I think I know it's going to look like. It's going to be not particularly good. So now I've gone from selling puts on Amazon and maybe buying shares to just kind of selling covered calls on the shares that I own. Apple, I think it's awesome that Qualcomm's going to report before them, so we're going to get some sort of window into what sort of sales Apple is actually going to report. Although I think that just like Microsoft, they might sandbag too. Why not take this opportunity? I mean, these guys are so smart. I would sandbag if I was them. I mean, the whole world expects it to be bad. Why don't I make it a little bad? And the market it takes the stock down just a little bit. Pfizer, I don't know. I don't like investing in healthcare stocks the same way as I don't like investing in tobacco stocks. It's like I don't like profiting off of, say, cigarettes, but I also don't like profiting off of people losing all of their retirement because they got to pay um, huge healthcare bills also. So I'm against both of those things. Intel will probably be okay, I think. Their stock always comes down, but how far can it go down? I think I'll start buying Intel under 10. Until then, right now I wouldn't touch them. Procter and Gamble, staple, again. Now the oil companies, they're going to have great earnings and revenue this quarter, but their projections are probably not going to be as good as what they've been accustomed to earning. Now, as far as the staples are concerned, the reason why I don't like them is they're super, super, super out of, like, it's out of whack. Like, the price that you're paying for them is just, their price to earnings ratios far exceed that of tech. And these ones don't grow. As far as I'm concerned, Procter and Gamble, Colgate, Pfizer, and all these, they're Kraft Heinz. They're not investments. They're trades. That's the way I look at it. And I'll probably do a video about this later on. But to me, an investment goes up with time and a trade goes flat. And you're either going to make money as it goes up and down because it's somewhat cyclical, or you're going to make money if it's like a dividend producer. Now, these can also be dividend producers that you want like in retirement. But if I was going to do a dividend producer in retirement, I would use RYLX, RYLD, QYLD, XYLD, BST, some sort of huge dividend producer. I'm not going to use Kraft Heinz, Procter and Gamble, Colgate. I wouldn't even use IBM. I would just go for, why not just use one that's going to produce twice as long as you're not going to get any increase on your underlying, why buy Verizon when you can have RYLD or QYLD or whatever? Like, that's where I would go for a dividend player. And I would never invest in these. I just think they're terrible. But the one thing that I cannot wait to have come up this week, and it's the one thing that I'm actually going to make a lot of money on, and that's this. It's Visa. Oh my gosh, what a gem. Okay, so Visa announces its earnings on Tuesday after market close. American Express already said that their earnings are great. Amazon just had their best Prime Day of all time. These guys are not a bank. We don't have to worry about loan losses. We don't have to worry about credit defaults. All we are talking about here is people spending money on travel, entertainment, goods, and services. And these are all the things that are super strong right now. Now, when we look at Visa, Visa is got a pretty low yield. It also has a very high price to earnings ratio. It always runs a little bit high. So these are like risks that we would say about Visa. The fact that it does run a little bit on the pricey side with respect to its price to earnings ratio. It has a net profit margin of 51% with a growth forecast of 18%. Now, this is one that I'm not only going to sell puts on before Tuesday, but I'm going to be buying shares and hopefully trying to make, like, say, $1,000, because I don't see a problem with this going up to $225. I also do see a problem with this going down to $205. So I think that Visa is a company that I'm going to make a huge play on this week. All right, well, if you got any of this video, yeah, please like, subscribe, hit that little notification bell. I'm actually going to release another video that's going to detail all of my trades that I did last week to kind of get out of all of my short positions. And I think that's going to be an interesting video once I make it. I'll leave a link in the description. Until then, we'll see you next time. Have a good day. Bye.